Welcome to Chapter 16, Exchange Rates and International Capital Flows. We're going to talk about how the foreign exchange markets work. If you've done some international travel, you've probably had to exchange currency from US dollars to some other currency, whether that's the Canadian dollar, or whether that's euro or the Japanese yen or the RMB in China. And we'll talk a little bit about how that market works on a macro scale and the effects that macroeconomics has on exchange rates and ways that countries try to navigate the challenge of varying exchanges of one currency for another. And the dollar is what's known as the reserve currency of the world right now, meaning that many central banks, like we talked about in the last class, choose to hold a good portion of their currency in US dollars because US dollars can be easily traded. And there's some historical perspective for why the US dollar is chosen. It was the last currency to come off the gold standard. And so the dollar, unlike other currencies, for a time could be exchanged for gold. And so, as a result, and because of the size economy being the largest economy in the world, it has become an important currency in international banking. So again, when you see a lot on a screen like this, it's always good to pause it, read it, look it over. But what it's doing is taking us through what happens if a investor, usually we should be not thinking of a wealthy individual, although you can in this case. Often we're talking about an investor could be part of a national government, could be a major corporation, could be a institution like the New York State teachers retirement system, but they're taking, in this case, 24,000 in US currency and they're converting it into pounds, which at the current rate of exchange, 24,000 US bought 16,000 pounds. So the pound costs more than a dollar in this example, which is generally true. I've been in Europe when it cost $2 for 1 pound, and I've been there when it's cost $1.40 for 1 pound. So a 30% difference in rate. Exchange rates then shift. Instead of 150, which is what got us the 16,000 pounds for the 24,000 US dollars, shifts to 160, so it takes $1.60 now to buy a pound. And if you took your 16,000 pounds that you got back here in the beginning and said, now I need dollars again, when you turned it back at that new exchange rate, it would actually come out to $25,000. So you made $1,000 on that exchange. If, on the other hand, we were thinking that the currency exchange might move in the opposite direction, it might be that an international investor takes their 20,000 pounds and buys $30,000 of US dollars. That exchange rate was still 150, but then it goes down as expected to $1.40. And they take their 30,000 in US dollars and they turn it back into pounds at that new $1.40 exchange rate. And instead of 20,000 pounds, they have 21,429, or they made a profit of 1,429 pounds. So that's the example here. It'd be nice if we always knew whether it was going to go up or down. Sometimes you guess one way and it goes the other, and you actually would lose money. So if you were looking at two countries' exchange rates, they would be mirror images of one another when you have the how many US dollars you can buy per Canadian dollar and how many Canadian dollars you can get per US dollar spent. So that's this little mirror picture here to remind you that those would mirror each other. And I can tell you just in my time here at Roberts, there's been enough exchange between two pretty stable currencies, the US dollar and the Canadian dollar, that have led to students paying 25% more or 25% less if they were buying a Roberts education in Canadian dollars, depending on what years they happen to be studying here. So exchange rates have real impact on real lives. When we look at exchange rates, we talk about a currency getting stronger or weaker. A strong US dollar means that a dollar buys more of other currencies. A weak US dollar means that the dollar buys less of some other currency that we're comparing it to. And so if you can buy more of another currency with a dollar, more pounds or more Canadian dollars with each dollar that you have, that's not good news for exporting firms. It makes their goods and services costly to internationals. It makes it's good news for foreign firms selling product here because when they get paid in those dollars, they can convert that into more of their own home currency. It's good for us tourists who are traveling, but it's not so great for foreign tourists who are coming to visit the United States. It's not great for US investors who are getting money earned on their investment in yens or pounds or Canadian dollars and now have to bring that back to the US and convert it to US dollars. But it's great for those foreign investors who have put money into the US, earned in US dollars, and are now turning it back into their home country currency. The weaker dollar, I mean, it's directly opposite. So if one was sad under a strong dollar, it's happy under a weak dollar. If it was happy under a strong dollar, it's sad under a weak dollar. And it turns out, again, pause, read things when there's detailed slides, but the impact of trading of dollars, you can think of currency as just another good that there's supply and demand for. And in this case, we're comparing the peso to the dollar and how that impacts the number of dollars that are traded. And we have a shift of demand to the right, which says that there's greater demand. So if you read over here, you'll understand why there was a greater demand, an increase in the demand for dollars. And you also see a shift left or a decrease in the supply of dollars. And as a result, you end up having to pay more for each dollar if you're using pesos in order to purchase them. We can see that if a currency is experiencing inflation, then it takes more of them to buy anything. Things cost more, and so you need more dollars to buy whatever that good or service is. As a result, in international investors would be less eager to hold whatever that currency is. We're talking here about US dollars and Mexican pesos again, and you can see that we had a demand curve move to the left from time 0 to time 1. That's a decrease. So there was a decrease in the demand. There was an increase in the supply, so the opposite of last time. And what we end up is being able to purchase the currency at a cheaper rate. And I just encourage you to see what's been happening in Venezuela in the last few years. I've mentioned it a couple of times, but there is a source of hyperinflation. It's almost unimaginable what's happening there, and it's only happened maybe 10 times in modern history from World War I on, and so the fact that it's happening right now in Venezuela, it'd be good for you to at least be aware of that. So this scenario we take you through here, a bank decides to borrow $1 million in US dollars, and they're going to pay 5% interest for that money that they've borrowed. They have to convert their Thai baht, and the exchange rate happens to be 40 baht to the dollar. So they need 40 million baht in order to get 1 million US dollars. So the bank lends 4 million baht out, 40 million baht out at 6% interest. And after 1 year, the loan is repaid with interest. So the bank receives 42.4 million baht. And what we're going to see is a couple different potential scenarios. So the 42.4 is the 40 million plus 6% over the year. So when they go to convert the baht back to dollars and pay their loan off, if the exchange rate is 40 baht to dollar, they would get 1.06 million. They pay their $1 million loan plus the 5% interest, 1.5 million, 0.5 million, sorry. And they have $10,000 or 400,000 baht at that exchange rate of 40 to 1 left over to cover expenses and as profit for the bank. That's how they earn their money. If, on the other hand, the bank converts the baht back to dollars, but the exchange rate has changed, and now it's changed so it takes more baht. The baht has gotten weaker to the dollar. It takes more baht to buy $1. $1 is stronger. It buys more baht 50 to 1 instead of 40 to 1 over here. So the bank only gets $848,000 in US currency, but they borrowed $1 million plus 5%, so they still owe the same 1.5 million. But they only have 848,000 to pay it. So they face a loss of over $202,000 for making that loan. And that's exchange rate risk in the banking industry. So under Keynesian theory, if we change the exchange rate, it can change demand. It'll impact demand, which impacts then the overall economy. When we depreciate the exchange rate, it makes imports more expensive, exports cheaper, increases aggregate demand for domestic made here and abroad. It stimulates the economy, helping end a recession. And you can think of back where the happy and the sad faces are to kind of think through this slide. Appreciating exchange rates makes imports cheaper, exports more expensive, decreasing aggregate demand, and it can contract the economy, helping to end inflation. So if you want to end inflation, rising prices that's happening too fastly, then you would want appreciation of exchange rates. If you're trying to end a recession, you want a depreciation of exchange rates. When capital flows from one country to another, it's invested in places where people see opportunity, where there's a risk return that makes sense for those investors. That can be really helpful to building a national economy. And so in the late 90s in South Korea, Malaysia, Thailand, Indonesia, there were strong inflows into those countries. They were seen as good risk return investments. But when they were forced to depreciate their currency, in part because of advocate investors like George Soros, many of the banks that had lent and borrowed, taken in money in one currency, owed it back in that foreign currency, maybe the US dollar. They struggled to make those repayments, and it plunged the economy into deep recession. So there are risks for taking on that opportunity for growth, but it's really hard for countries to see substantial economic growth if they're not large nations like China, India, the US that can have strong internal demand if you need to trade with foreign partners. it's really important that you have inflows of capital from investors in other parts of the world. And when that starts to leave, it creates a significant strain on the local economy. And so that's what happened in South Korea, Malaysia, Thailand, and Indonesia as money moved back out. And similarly in 2002 with Argentina, a similar historical example. So as a result, to address this, there are actually several different kinds, and it's a continuum of ways that countries can allow their currency to change relative to others. So if you want to leave it completely to the market, you would use a floating exchange rate. The US does close to this kind of policy. If you want it to be a little bit less market determined, you can have a softer exchange rate that the central bank can insert itself to maybe stop it from changing too substantially in a certain amount of time. And then there's what's called hard pegs. And the central bank there intervenes in markets to keep currencies fixed at a certain level, probably within a range. So we won't let our Guatemalan quetzale exchange beyond a certain range with the US dollar, which I believe is what Guatemala has used only because in traveling there over a 15-year period, the exchange rate moved very little. And given the size of their economy, I would have expected more variance. And then there are even countries that choose not to have their own currency. They could use the currency of a different government. So there are a few small countries that only use the US dollar and don't have a currency of their own. So you can manage risk in part by, instead of letting the market determine, if you're worried that your currency as a small country might be too volatile, you can begin to put some parameters around how fast it can change, even up to choosing not to use your own currency. I remember when the European Union was formed and the movement towards using the euro, maybe not necessary for the Deutschmark in Germany or the pound in England, but really helpful for the lei in Romania, for example, which was trading at 33,000 to the dollar, I think the first time I was there before they switched to the euro. So your project for this time, you're planning a vacation. You don't have a ton of money, but you want to get a really nice experience. So I want you to choose 3 places that you might travel to. So pick 3 countries, look at the exchange rate with the US, and convert the $750 you'll have to spend once you get into country into each of those currencies. And then based on what the exchange rates are and what you think you can buy with that, which one do you think is the best value for you? What might be the place that you could do the most, experience the most as a result of exchange rates? Look forward to seeing where you're traveling to. All right, take care.